Did you know that some of the most successful investors invest in boring stocks? With all the uncertainty in the world, like wars, geopolitical risks, and so on, I prefer companies that not only have solid financials, but also consistently reward their shareholders. And that's why I love companies that have increased their dividends for at least the last 25 years. They may not make the headlines like the latest AI or quantum stocks, but these companies have stood the test of time, delivering consistent value to investors like you and me. So today, I'm going to be covering 3 of the best buy-rated dividend stocks that not only pay high yields, but also have strong potential for upside. And of course, they've paid dividends for longer than I can remember. Stick around to the end because I'm going to break down why they're worth your attention and whether now is the right time to invest. But heads up, I'm not a licensed financial or investment advisor, so this video is for informational purposes only. For this video, I started by screening my watch list for stocks that have paid increasing dividends for at least the last 25 years, picked those with the highest yields, and then narrowed them down by analyst ratings. The top 4 were Realty Income Corp, Federal Realty Investment Trust, Chevron, and Amcor. Now, Realty Income had the highest yield, but of the top 4, it had the lowest rating, so I removed it from the list. By the way, I wanted to give a quick shout out to the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investments of all skill sets and risk levels. You all know that I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beaten the market by more than 5 times, and you can scan this QR code or check the link in the description to get your 10 stock picks right now. Okay, so let's break down the list of my favorite highest yielding stocks to buy right now, and we'll start with Amcor. Amcor is a global leader in packaging solutions. Now, you might not think much about packaging, but this is a company that makes containers, wraps for everything from food and drinks to healthcare products. If you've ever opened a soda bottle or peeled back the plastic on a snack item, there's a good chance that Amcor had a hand in making that packaging. Now, what I think that makes Amcor so interesting right now is its upcoming merger with Berry Global, which is expected to create one of the largest packaging companies in the world. They're projecting significant savings post-merger to the tune of about $650 million on a combined $3 billion in annual cash flow. Now, while revenue dipped slightly to $3.24 billion, operating income went up 22.73%, and net income was very similar, also up 22.79% to $167 million. And that, folks, is a sign of solid cost management, which is crucial in the industry. Now, dividend-wise, Amcor comes in around 5% annually, and they've increased their dividends for 41 consecutive years. And not only that, the dividend has doubled over the last 5 years alone. I think this is some really impressive dividend growth for a boring packaging company. And here's the kicker. Analysts have a consensus buy rating on the stock with a high target price of $12.50 per share, reflecting a potential 25% lift from its current levels. By the way, what do you think about a 5% yield on a company that's increased their dividends for 41 years? Let me know in the comments below or give me a like on this video. Next up, we have Federal Realty. This is a real estate investment trust, or a REIT, and it's a company that comes up a lot on my Discord server. It's a company that focuses on retail properties in some of the most high-demand areas in the United States. And I'm talking about places like Washington, D.C., Boston, San Francisco, and Los Angeles. Now, these aren't just your standard shopping malls. FRT also owns mixed-use developments that blend retail, office, and residential spaces, making their portfolio a lot more diversified than your average retail REIT. Now, let's dive into the numbers. The company's occupancy rate hit 94% in its latest earnings report, which is up 1.7% year over year. This is a sign that the business is very stable. More importantly, its funds from operations, or FFO, came in at $1.71 per share, up from $1.65 last year. And FFO is exactly what matters when we're looking at REITs, because this is where your dividends come from. Right now, FRT pays $1.10 per share per quarter, which gives it around a 4% dividend yield. That's a solid payout in today's market. Now, you might be asking, why should I buy a REIT that pays 4% when I could buy a bond, or a treasury, or a CD? Well, what's even more interesting is that despite these strong numbers, to me, FRT looks a little undervalued. The stock is trading at a trailing PE of just 15 times, and that's under the average of 15.6. But here's the thing. Analysts have a consensus strong buy rating on the stock with a price target of $134. And that means there's a potential 27% lift from its current stock trading price. So if you're looking for a stable dividend stock with growth potential, Federal Realty might be worth a closer look. And last but not least, we have Chevron. This is one of the biggest names in the energy sector right now. Now, Chevron isn't just an oil company, it's a fully integrated energy giant that does everything from drilling and refining to producing natural gas and chemicals. To diversify, they're also getting into the renewable energy space, so they're positioning themselves for the long term. One of the more interesting developments is their partnership with GE Vernova and engine number 1 to build power foundries. Basically, they're natural gas power plants located near major data centers. And this, I think, is a really smart move because data centers require massive amounts of energy, and Chevron is setting itself to be a key supplier. If you believe in the long-term growth of cloud computing and AI and data centers, well, this could be a game changer for Chevron. Financially, the company also appears really solid. Revenue was up 10.7% year over year, and net income was up 43.4%. That helped the company boost EPS to $1.84 per share. And here's the kicker. The energy sector is right now in a strong uptrend, especially with the renewed focus on increasing U.S. oil production. With oil prices firming up, Chevron could be in for so much more growth. Now, let's talk about Chevron's dividends. Chevron currently pays $6.84 per share annually, which translates to about a 4% yield on the stock's current trading price. They've also increased their dividend 37 years in a row and almost 37% over the last 5 years. Wall Street is also really bullish on the stock with a high target of $203 per share, giving it a potential upside of about 30%. So if you're looking for a dividend stock with exposure to energy, I think Chevron is your number one candidate. Finding quality dividend stocks with a history of consistent increases is one of the best ways, I think, to build long-term wealth. But remember, every investor's journey is different, so it's always best to invest with the help of an advisor. Of course, if you're looking for income stocks, these 3 dividend stocks, Federal Realty, Chevron, and Amcor, offer a compelling mix of yield, stability, and upside potential. What do you think? Do any of these stocks interest you? Let me know in the comments below because I'd love to hear from you and, of course, respond. Thanks so much for watching, and I'll see you in the next video.